Thanks very much, Narina. Good afternoon, everybody. I'll try and be relatively brief. The title of this is completely wrong. I'm afraid what you've got there is a title for the first 50 pages, which is all the rather dull stockbroking stuff about the here and now. But I'm going to talk about something much more interesting, if I can get to the middle of all this, which is really to sort of go back to that book that Narina mentioned that I wrote in 2005. The research notes were actually written in 2004, and just sort of show you where we are in terms of the economic development that's taking place in the emerging world. Just it's really sort of to circle round on everything we talked about this afternoon, and why is this all going on? Why are we talking so much about this? Why is this so crucial to I guess, firms like ourselves, firms like WPP, to consumer products firms, to businesses worldwide? Well, it's really because of what you see up the top there, which is the reshaping of the global economy. Okay, so this is from the economic history literature, the footnoted people responsible, Paul Byrock, Sam Huntington, a number of others. But it is astonishing, isn't it, really? It goes back 250 years. It's to some extent an extraordinary story, a very sad story, actually, a lot of it from the perspective of China and the emerging world. But now we're coming full circle. And in fact, what I often point out to clients is that what we're going through the last 20 years is faster than any transition in the last 250 on that diagram. The regain in share in the global economy, this is scoping it in manufacturing, which is where we have the best data, is faster. The gain that China, India, Brazil, Mexico, Korea, the other EM are making is faster than any share loss they had in the 19th century. It's faster than the share take that the US had versus Europe through the two world wars. So it's a hegemonic shift. It's a hegemonic regime shift. We won't have time today to talk about it, except to say that when these things move, they don't sort of suddenly reverse. The only sudden reversal you see on that chart is really the collapse of the former Soviet Union, the sort of Soviet military-industrial complex. But this is sustainable in our view. It is only going to carry on. So we're really going back to the past. We're going back to an Asia and EM-centered global economy in the deepest sense. And one of the drivers of this, which is so important to the companies you just were hearing analysed, is that we are generating very substantial employment growth and real wage growth in the emerging world. There's a virtuous circle here of economic development, very evident in manufacturing, also evident in services, where China, in the pink there, is generating double-digit real wage growth for a long time now already through economic development. At a time when you're not getting that anymore in the Western world. You, in the US, have had actually negative real wage growth now for over 15 years in manufacturing. You've had whole economy median incomes actually declining for over 10 years. Now, again, not enough time to go into what's really happening here, but a lot of it has to do with a global labor market arbitrage in terms of globalization, creating profound winners and losers. But there's also a development process that's very positive, certainly from a China and EM perspective. And it's only going to likely carry on. On the right-hand side, you've got labor costs per hour against productivity on the horizontal. And we have effectively quadrupled Chinese productivity per hour in manufacturing in 20 years or so. And so we've gone from 5% of the US level to north of 20%. And Chinese wages, quite naturally, have been rising from about 3% of the US level to about 11%. But we're not transiting up a 45-degree line. And that's, of course, why it's sustainable. If it was a different picture of Chinese wage inflation that wasn't matched by productivity, it wouldn't be sustainable. But it is. It is sustainable. Now, China, of course, is doing this far more than any other EM. But actually, it's Brazil, of the countries we talked about this afternoon, that's growing employment the most. 50% growth in formal employment in manufacturing in the last few years. All the EM are growing employment in manufacturing pretty well, certainly all the large EM. None of the developed world is growing it. In fact, none of the developed world is really growing private sector employment at all anymore. It's a gigantic challenge, as somebody asked the question earlier on, for economic development in the Western world, which faces many other issues, the household debt legacy of the boom period amongst them. I will in a minute get on to my comments on the survey, because I do want to make some of those. So if you're waiting for that, it is going to come. But I just wanted to contextualize everything that we've been doing this afternoon by using these slides. I do think it's important to notice on this diagram, again looking at productivity against labour costs snapshot at the end of '09, that India is absolutely not doing what China's been doing in terms of this self-sustaining thing. So it's interesting that we're not actually here yet at the point where we're talking about the top 50 brands in India. There are some great Indian companies, sectors like software in the exporting side. There's some fabulous banking names. One of them was touched on earlier by Kirill. But in terms of the overall economic development, I'm somewhat more skeptical on India and indeed on Russia than I am on China and Brazil. Unfortunately, if we had a kind of something a bit more interactive than this, you would see that these dots are moving, and basically by year, and the dots that are moving the most are the China and the Brazil dots, and actually Korea too. But the heart of the story, of course, is generating very large middle class, which again we've referred to a lot this afternoon. The book that I wrote in 2005 predicted that the Chinese consumer alone would come to dominate the global economy within 10 years. And it was considered fanciful, I think, by most clients and indeed many colleagues. But there was a logic to the conclusion, namely that some of the issues in the Western world were going to come home to roost within 10 years. That was in the book, quite explicit. Consumption GDP ratio was way too high. In the US, in the UK and elsewhere by '05. It had only one way to go, which was down. And at the same time, consumption was very likely to start to surge in China and elsewhere. And it was quite clear to me that these sorts of projections on the left, that the BRICS that had at that point only 30 million households in the middle class could be above the US, really within a sort of a 10-year horizon, China alone shortly thereafter. And that's effectively what's happened. We've quadrupled the BRIC middle class in just 10 years. It isn't, of course, just GDP growth. It's GDP growth, it's income and wealth inequality, which again we haven't talked much about this afternoon, but starting from a very equal distribution to a much more unequal distribution. Again, there are developmental sustainability issues around that, but that's part of the story in all of the BRICS. And then, of course, there's currency too, because this is in dollars. So the currency is structurally very undervalued, and now the structurally overvalued currencies, like the dollar, the pound, trading much weaker as of course, the denouement for the crisis set in. So where do we go from here? Trees don't grow to the sky, of course. If you look at the right-hand diagram, the two lines that kind of asymptote, the orange is Brazil, and the green is sort of Russia. It's sort of hidden underneath Brazil because they're roughly the same size. You will form an urban middle class of about 50 million in both those countries by 2020 on our projections, and then it will be largely finished. But the process has a long way to run in China and in India. If you ran it out to 2030 on China, which is the blue, you're going to probably end up about 350 million households at this income level. 2030. I'll come back and tell you if it happens. But 350 million households. So you will leave about 100 to 150 million households at that point who are still in poverty. Okay, but the rest of it will have formed this, on this definition, 10,000, which is obviously quite a low income level, you will have formed that middle class. It's just gigantic. The world's had never seen anything like it. So big or so fast. Has the world the resources to cope with it? We will be challenged, certainly, particularly in the area of oil and food. But that's the trajectory. And so far, actually, from what I wrote in '04-05, we're going pretty well exactly on track, actually. And notice, of course, the US, Japan, Europe, I mean, it's de minimis, of course, in terms of what happens. But this reshapes everything. And P&G is a classic example on the bottom left there. In just 5 years, the share of their business that's in emerging markets has gone from less than a quarter to approximately a third. So they're growing their revenues in emerging markets about 18% per annum for the world's biggest consumer products company. So for them, it's a growth business, just as it is for some of the companies we looked at. Okay, so I'm going to now not do the rest of this in the interest of time, except just to, again, to just look at this income distribution point. Some of those brands that you see there, like the wine and some of the spirits, foods brands and whatever, I mean the internet brands like Baidu, they're catering to this top end of the distribution, which is appearing very, very quickly in China. When I wrote my book, we only had 2.4%. That was really in what was defined then as high income, over $15,000, 2.4. It's now 7.2. So it has effectively tripled in 5 years. So it's no surprise some of the companies we just heard about have phenomenal revenue growth if they're addressing a market that's basically tripling in size in 5 years. Why does it happen? It's the consequence of a market economy. Because you didn't price labor or capital or land or other assets in anything like a market economy, you had a forced equal distribution, okay? For better or worse. I'm not making any normative statements about this, but if you allow those processes to take place, just as in the Western world, the distribution gets more skewed, and that's what's happening. And so, you know, it's no surprise to see some of those names appearing very quickly, very fast companies that are in that part of the distribution. I think I'm almost out of time, but I did just want to say, just in reaction to some of the names up on there, I mean, you know, fabulous piece of work. I sort of, 85% of it, my gut sort of agrees with. I recognize all of the names, but there are some, if I was just to ask a question here and try and be a bit more of a discussant, that are, to me, missing. And I'll just name 3 of them and maybe ask you to respond. C-Trip is one, web-based travel. I'm not sure if it was below the 50 cutoff, but fabulous company that from what I know, is very widely recognized as a brand within China, utterly dominant in the web-based travel area. Jack Ma's company, Alibaba. I spoke on a platform with Jack Ma almost 10 years ago. I've never spoken with somebody who's so dynamic. I mean, he's just fizzing with energy. He's now on Times Square right now, okay, under the China wealth as Hu Jintao visits America. Jack Ma's there, but he's not in your survey. Now, is that because he's a business to business?
He's listed in Hong Kong.
Oh, it's because he's listed in Hong Kong. Yeah. But a lot of these, Tencent is listed in Hong Kong.
Maybe knows it
Tencent. Okay. So yeah, look, I don't, want to be, but it's in the interests of, improvement or whatever. The third one is NetEase, all in this sort of new economy thing, and it just felt that a little bit for me that there was too much of these China giants, and not enough of these really extraordinary young entrepreneurial things, which my perception is, and obviously you did the work with the consumers, that they probably ought to be there. So that was my attempt to be a little bit of a discussant for what's a fabulous piece of work. So with that, I will stop and see what I can say.
Thank you, Jonathan.